Hello, I'm Al Kutchins, one of the founding partners of Kutchins, Robbins & Diamond, located in Schaumburg and Chicago, affectionately referred to as KRD. We're a full-service CPA firm with 80 professionals and administrative staff serving multiple areas, including manufacturing, family-owned businesses, and not-for-profit companies. We've been servicing these manufacturing clients for over 75 years, and we're proud members of both the Illinois Manufacturers Association and the Technology and Manufacturing Association. We differentiate ourselves at KRD by taking a holistic approach to working with our clients. We look at the business, the individuals, the retirement plans, the family partnerships, any trusts, and we try to balance the impact of decisions on one side and what happens on the other. We're big fans of Stephen Covey, and we believe if you work with an end in mind, that you can create the path to help any client achieve their goals. Today, I want to talk about 4 tax planning strategies that we have helped our clients implement and think that it will help you reach your goals of long-term wealth accumulation and tax savings. So we're going to discuss the values of owning your own building, creating your own private foundation, employing your children, and converting your traditional individual retirement account into a Roth IRA. So let's begin with some ideas relating to owning your building. If you've purchased a building recently, it's important to look at taking and doing a cost segregation study. The purpose of the study is to break the building, which for tax purposes generally has a 39-year life, into smaller components. The land improvements, the heating and air conditioning, any furniture and fixtures, the roof, with the idea that each of these individual components has a shorter life than the 39-year life of the building. This effectively reduces the average life of the building, accelerating the depreciation and the related tax savings. So you get an immediate return on your investment of the study through the tax savings. One of the other things that we like is to look at how you own your property. We're big fans of family limited partnerships or similar flow-through entities. This gives you the ability to leverage gifting through financing, shifting income to other family members, but not necessarily tax savings if your children are under 25 and full-time students. This can also act as an asset protector in the event of a child's marriage. It's, in effect, part of your prenuptial agreement planning to protect your family assets. Hopefully, you'll charge market rents and even have positive cash flow that'll be sheltered by the depreciation. Having the property in a family limited partnership or similar entity makes it easier to do annual gifting, and you're able to take the advantages on valuation for discounts for minority ownership and lack of marketability. It also provides you some additional asset protection in that, as we all know, we're in a very litigious society. So just a small example. One of our clients purchased a building last year for $1.4 million and made $321,000 of improvements. The cost segregation study valued the land improvements at $61,000 at a 15-year life, and the furniture and office equipment at $278,000 with a 7-year life. Based on the highest tax bracket of 39.6, the tax savings for the first 7 years was $14,000. This gave you an immediate return on your investment, far exceeding the cost of the study. Our next idea that we are particularly fond of, because our firm and my family individually are involved in many charitable activities, is establishing your own private foundation. We have actually set up our own private foundation in memory of one of our children and raise money annually that we distribute to other 501c3 charities. While we're not the Rockefellers, the Carnegies, or the Mellons, the private foundation can be a wonderful tool for tax planning and instilling family values and charitable giving. News articles often overstate the complexities of establishing and maintaining a private foundation. From our experience, the organizational documents and the initial filings for tax exemptions cost between $2,500 and $3,500. And this is a one-time cost. And after that, the annual tax return preparation ranges from approximately $1,750 to $2,500, depending on the complexity of your transactions. You can generally donate up to 30% of your adjusted gross income, 20% if you're contributing capital gain property. And you only need to distribute 5% of the average monthly asset balances each year so that you can accumulate assets within the foundation so that if you wanted to fund a larger project, such as naming a building or endowing a scholarship, you're able to do that. We get together twice a year and look at different charities to contribute our money to, and we feel that this instills family charitable values and hopefully will continue for multiple generations. It's also a great estate planning tool, assuming that your assets are above the approximate $5.5 million estate tax exemption, through either setting it up prior to your death or in your estate planning documents to take effect at your death, you can contribute assets over that amount of money. So I want to talk about two examples that might work for you. One is you sold the property or your business and you had a large gain. In this example, I'm going to just use $750,000. And you also took $250,000 of compensation that year. If you would contribute the $250,000 to the foundation, you would be able to shelter all of your ordinary income at the highest tax rates. And the second example is one that took place at death. Assuming your spouse had predeceased you and your estate was worth more than the $5.5 million. If you donate anything over the $5.5 million to a charitable foundation, you get an immediate tax savings of 50%, which is the highest estate tax rate. So one of our clients had $2 million in excess of the exemption. So by contributing the $2 million to a private foundation, which their family members then managed, we were able to save approximately $1 million in estate taxes. So, our third idea is one that I did implement for my daughter, and I put her on the payroll. She's always helped at the office. I said I wasn't going to be like my father, and I'd spend more time with my kids, but I was exactly like my father. And if my kids wanted to see me, they had to come to work. So they learned how to file as soon as they can they knew the alphabet. So the idea is to shift some tax savings, some income from your tax bracket, assuming that you're in the highest tax bracket, to a near zero tax bracket. Now, yes, there's going to be the Social Security and Medicare taxes generally on the amount that you pay your child, but you'll be moving income from year 39.6 down to about 15.3% at the federal level. So the child will get a standard deduction up to $6,300. So that would shelter the entire $5,500 that you're paying your child, because that currently is the maximum IRA deduction. We'd also recommend that you consider using the Roth IRA, because the Roth, under current law, the income will never be taxed when you distribute it, assuming that you let it accumulate till after age 59 and a half. If you need to take it before age 59 and a half, there's no penalties. If the money has been in the account for 5 years, you would only pay income taxes on the earnings. So this is also another way to augment college savings, although I prefer to have the money stay in there longer. So if you contributed $5,500 a year from ages 10 to 65 with an assumed interest rate of 5%, that money would accumulate to over $1,500,000. Now you're saying, I'm not going to keep gifting to my kid till they're 65. I need the money myself. Well, if you only make 12 annual contributions from age 10 to 21, at 5%, this will grow to $750,000. The power of compound interest is amazing. My daughter Emily was able to afford the down payment on her first house by using the money that we had put into her Roth IRA. So our last idea also deals with individual retirement accounts, and it's the power of accelerating income taxes and converting your individual retirement account into a Roth IRA. So you might say, why do I want to pay taxes today and not have as much money to grow in my IRA? Well, two thoughts related to that is, hopefully you've accumulated some after-tax money and you can use that to fund your tax liability, and you will not be reducing the funds in your individual retirement account. The second is that the money now will grow without any further income taxes in the future when you take it out. And as I said in the prior example, is that if you take it out after age 59 and a half, there's no penalties. You're also not required to take required minimum distributions, so the money can stay in the Roth IRA forever. And when it's inherited, your children will then be able to take it out over their life expectancy. Another example is a strategy we used for one of our clients. Her husband had predeceased her. She was in her 80s and not in good health. And she had $1,600,000 in her traditional IRA. By converting the IRA into a Roth IRA, we created a $640,000 federal estate tax liability. Illinois, fortunately, does not tax retirement plan distributions. So what we were able to do is pay this $640,000 federal tax liability out of other after-tax assets, therefore reducing her taxable estate. And she was in the highest estate tax bracket at 50%. So we had a $320,000 estate tax savings when she passed away a few years later, therefore passing additional wealth onto her family. So these are 4 of our favorite planning ideas. They're all easy to implement, and we're here to help you. You can contact us at 847-278-4335 or Kutchins at KRD-CPAS. We're also in the IMA directory. Thanks and have a great day.